Good evening. Welcome to the Redefine half-year results presentation for the 2013 year. As usual, I'll be doing an overview and strategy review. David will take you through the property portfolio, and Andrew will take you through the financial results. Our strategy, as usual and as it always has been, is that Redefine is committed to being the property owner of choice. It's not necessarily to be the biggest player, but the best. The company's primary objective is to provide sustained and growing income for investors. Underscoring this is our pursuit of revenue-enhancing opportunities so that we can sustain increases in distributions and secure the prospect of long-term capital appreciation. Our investment proposition is we have attractive real yields, the prospects of capital appreciation, high visibility of earnings, a diversified property portfolio, improved quality of the property portfolio, very limited speculative development, geographically diversified. There's an element of rand hedge through our investment in RIN. We've got a proven management team, and we are no longer reliant on fee and trading income. The graph on the right shows you that 74.5% of our property asset base is South African property, 18.2% is listed, and international accounts for 7.3%. This is just to understand our strategy, and I'm not going to go into detail. It's self-explanatory, and you can have a look at it, but we embarked on this strategy 18 months ago, and it's how we are going to deliver and are delivering sustained value to our investors. Our investment philosophy, we start with the bottom-down process. Our deal turnaround times are short. It starts in my office and works its way down through the various divisions, not the other way around. Our investment criteria, first we look at tenants, the period of the leases, consistent renewals, the property location. It's got to be key to attracting our ideal tenant profile and where we want to be. Property size, we don't look at properties unless there are exceptional circumstances of under 70 million, which offer management economies of scale. As we said previously, focus is on prime areas, high growth nodes, what we term hotspots, and pricing is obviously dictated by the market. At the moment, there's a strong demand for prime assets, and it's not easy to come by, and pricing is tight, driven by low interest rates and the availability of cheap funding. All properties are considered on their merits, and we're obviously giving preference to retail so we can change our mix. Our offers are positioned to be compelling, so we always look to see, is there something we can add that makes a good deal better, or something that we can do which will cause the seller to choose us over a competing bidder. So just by way of example, and to deal very briefly with our last major acquisition, which was East Rand Mall. The process was quite simple. What happened was that Sanlam advised certain players in the market that they wished to dispose of it. Vukile had a preemptive right, and they sent out to those people who were interested a pack detailing income, expenditure, and a number of other items which related to the centre. So the first thing we did, we thought we'd be clever, and we went to Vukile and said, will you sell us your preemptive right? They weren't interested in that, but it was a good try. It also told us that, having not wanted to sell their preemptive right, that they were going to want to remain in, and we then offered, if we were successful, to partner them. Based on the net income projections that we were given, and having walked through them all, looked at trading densities and opportunities, we believe that the property was in truth of fact worth about 7.25% forward yield, which would have amounted to about 2,125,000. But we also knew it was going to be a highly competitive bid, and if we wanted it, we would have to pay a little more. So we went in at 7%, 2.2 million, 75 million more than we thought it was actually worth. But when we looked at this, we said, okay, well, that adds 1 year to the payback period. And in terms of our funding costs, it cost us about 5 million a year in income. As it happened, we were correct because there were 2 bids which were identical and a number of bids around the 7.25%, 7.25% yield. So with 2 bids identical, why was ours successful? Quite simply was one of the things we did was make it as clean as possible. We put our bidding together with a board resolution. We had the approval required, and that was the only approval we required. And we had a letter from our banker stating that the funds were available. So our only condition was Competition Commission, whereas we understand the competing bid had a number of other conditions. Insofar as the building itself is concerned, yes, there were a number of items that needed attention. This came out in our due diligence and were attended to by the seller. Whilst we also understood that the building needs some money spent on it, we didn't think this was material, and this will be taken care of as and when we expand and use the 11,500 square meters of bulk that's available. We've looked carefully at all of the trading densities, which tenants need expansion, who's not there, and over the next 12 months and 18 months as leases expire, we'll be implementing some value add to the East Rand Mall, and very, very happy with that purchase. So that just gives you some idea of the way we go about things, a very brief one, but we certainly just don't run around and decide on a price. It's carefully considered, it's debated at length at our exco, and then taken to our investment committee and ultimately to the board. As I said, about 18 months ago, we changed our strategy. We told you what that strategy was. We very much kept to it. So where are we 18 months later? First of all, our investment proposition has been substantially improved. The average value of our properties is now 83 million. It was 54. Our single tenanted properties by value have increased to 31% of the portfolio. Our percentage of A-grade properties by GLA has increased from 50% to 65%. The percentage of properties outside the Cape, Gauteng and KwaZulu-Natal has decreased from 14% to 7%, and these are largely retail, which we'll keep. Our renewal success rate has lifted to 82%. Our core property margins have increased from 73.2 to 76.7, and we think there's still some more room. Our average cost of funding has decreased from 9.6 to 8.6, and that will come down further next year. Our reliance on lumpy, non-recurring income has been totally eliminated, as you'll see from these results. And the restructure is ongoing without suffering much dilution in earnings on the revised base. So we started off 2011, we had about 450 properties. We're almost down to half. The first big chunk went to Arrowhead, and I think that's proved to be more successful than anybody, including us, ever thought. So that was the real impetus, and we've continued on that base. It is part and parcel of our function, and although we are largely complete with the sales process, we're always going to be selling something because it's our job to recycle capital. So when we find a building that's mature or is not giving us the required growth, we have a look and see what we can do with that and recycle it if we sell it and reinvest the money in a better quality property, which will over a period of time give you much better returns, both in terms of income and capital appreciation. So that's where we are. The only change to the strategy, we've stuck to the original plan. Fountainhead, the acquisition of the property portfolio, would have largely completed the metamorphosis of our portfolio. As you know, we've now had to withdraw our offer for the assets and own 46% of the funds. So essentially, we have switched about 60% of our Hyprop holding into Fountainhead units. That situation will remain for a while, and then we'll revisit. But in the meantime, we're quite happy with that, because if you go back in time when we got involved in Hyprop, it was about a 6.50 Rand or 7 Rand share price. Today it's touching 80 Rand. We think that that's now mature, and we did think that. We think there's a lot of opportunity within the Fountainhead portfolio, and we'll seek to be looking to add value to that portfolio for our benefit and for the remaining shareholders, and then we will decide over a period of time whether we will revisit the offer for assets. There's a shortage of well-priced assets, so that meet our investment criteria. So that necessitates the need to develop or partner developers to create new investment opportunities. We've now got to the stage where we can actually develop really good quality properties if they're tenant driven at yields in excess of what we can buy these properties in the market. So that's something which we will pursue, and that's a small change to the strategy. Priorities for the rest of 2013 and going into 2014 is to reduce the high exposure to government tenanted offices. This was part of our original strategy. We are very far down the line in achieving this and hope to sign an agreement in this regard in the next week or two, and that will complete that one. Simplifying the RIN holding. As you know, we are looking at an inward listing. It's all been going reasonably well. There's now a hiccup at the Reserve Bank side, but we hope to get that sorted out shortly, and hopefully prior to year end that will be resolved. We will continue to pursue pre-let tenant demand driven development opportunities. I think you all know that we were awarded the Weber Wenzel tender for Sandton. We've already started demolishing, and it's that kind of opportunity that we look at. We've also just completed a distribution warehouse for the JD Group and are completing one in Cape Town for More Sport, and we continue. When we took over Apex, we inherited an electricity contract. We're now internalizing that, and we think that will improve our electricity recoveries. We've also got to bed down the Fountainhead property management. As I said earlier, I think there's a lot of opportunities in that. Focus on reducing our cost of debt even further, and if possible, deepen our presence in Australia. Cromwell has been a fantastic investment for us. They look at some really nice opportunities, and if we can get Reserve Bank approval, we would like to partner them in some of the opportunities directly, as opposed to increasing our shareholding, which in terms of Australian law becomes quite difficult if we go over 30%. With that, I'll hand you over to David, and I'll be back a little later to talk about prospects. Thank you.